Hello, my name is Eddie Tofpik. I'm Head of Technical Analysis and Senior Markets Analyst at ADM Investor Services International Limited. And here is your weekly technical analysis of LME 3-month lead and tin. I'll start with LME 3-month lead. Okay, it is still of great comfort here, even after the falls, the rises and now recent falls once again, that this market still keeps within the broken May to October 2020 bullish shift pitch hook that was originally drawn, well, now over a year ago. To recap some of the significant actions prices had since this past August, moved down from the upper tine, currently at 24.78, through the middle tine, currently at 23.08, all the way down to the lower tine, currently at 21.38, where they were halted to a great degree by the combination of the slowly rising long moving average, currently 21.95, and the big 50% Fibonacci lines of the March to August move at 21.60, plus the February 2018 to March 2020 move at 21.28. The market consolidated and in early October started to rise again, back up through all those previously mentioned supports that were now resistances, and peaked out 3 weeks ago at the upper tine. We've since seen the market dip down through the big old 50% Fibonacci line of 2010-2011 move at 23.78, where it found some transitory support before last week and now this week dropping down through the congestion from July 2018 in the 23.31 area. Today the market followed on from yesterday's bearish opening Black Mariposa with an open below the key 23.31 level, and has so far punched down through the middle tine, the medium moving average, currently 22.94, and the bottom of a small bear channel evident since late October, currently 22.89 to 23.43. The fall has been halted so far just ahead of the flatlining short medium moving average, currently 22.77, but this, along with the October 2019 high at 22.63 that is just below, do not really look that strong. We may end up seeing a move lower towards the 50% Fibonacci line of the June to October 2018 move at 22.21, or even the rising long moving average that's below that, currently at 21.95. Overall, this move down is at least a pullback, if not a failure, of the carefully constructed bullish diving board pattern seen since August. To give a quick explanation, the action from early August to mid-September was the diving board. The drop from mid-September to the low of late September was the dive off of the board, and the move back up from early October to date, well, that was the swim to the shore. It's not a common pattern, but is one that has been valid until recently at least. I had detailed some 4 weeks ago the initial topside target X for the pattern would be in the 24.11 area, for possible secondary topside target X1 in the 24.63 area. As you can see, target X was achieved 4 weeks ago, and if it wasn't for having the upper tine in the way, I'm fairly certain we'd also achieve target X1 on top of that as well. So, whilst I have been minded to postpone target X1, I think I may just call it a day on this pattern and call it achieved. I'll still give it one more week. You see, it all now depends on whether the action from the start of October to now is either a topping action, the pattern of which is yet to be determined, or a possible bullish halfway hesitation, maybe even a bull flag. That is why these next few weeks will be interesting, as we will eventually see the construction of whether this is a top or a continuation pattern. Early last week was the first week that it looked like it may have been a bullish continuation pattern, such as a flag or halfway hesitation. However, this week has seen the onus change to it being a possible topping action in the big picture scheme of things. It is still way too early as yet, and it would be reasonable to give the market some more time to determine its intent. However, that does not stop seeing further immediate declines, especially to the October 2019 high. LME 3-month tin. I have been repeating this here again and again for months and months now. The overall bullish incentive is alive, well and strong here. This was and is because of the original move up within the January to March bullish shift pitchfork, which had started back in March and then translated to a higher level in April, resulting in prices moving up over the middle tine, currently 37.195, of this same January to March bullish shift pitchfork. Our prices even managed to reach up and over the upper tie above, currently at 39,580, back in July and August, and even as recently as mid-October. Yet in all that time, prices have always come back within the folds of this bullish pitchfork, as it did most recently. In all this time, this bullish pitchfork had and still has driven prices higher. Now admittedly, I, and I am sure you as well, believe that no market can head in one direction all of the time forever. Thus we saw major corrections back down in August, in late September, and most recently 3 weeks ago. Yet it's important to note that despite these corrections, the market in all its pullbacks down has not managed ever to break the same bullish incentive seen since March. The evidence for this can be seen by how this market is still today well within the bullish shift pitchfork, just over the middle time, currently 37,195, and travelling along it nicely upwards along it. Another point to note, and this may become more important, if the lower time, currently at 34,815, is challenged, then one should take into account that this lower time has been married to its long-term partner, the rising medium moving average, currently at 34,730, since at least August. It may well be that if we see a separation of these two, the lower time and the medium moving average, then perhaps then, we may start looking at the bullish incentive as maybe finishing. This is no more than a conjecture on my part, but it does have a certain symmetry to it, so I suggest special attention to those two. This brings me once again to my final point, the same final point which I have repeated from previous commentaries. It is this, and I quote, "It can be hellish to rely on only one pattern, because it can be hellish when it breaks." End of quote. So that's it. That is where we are now, once again. Thank you for listening. This weekly broadcast gives essential market patterns and consequences. Please be aware of the risk disclaimer posted with this broadcast. Copyright is Eddie Tofpik and ADM Investor Services International Limited. And here comes the final bit.